Let's get more on that story with Jim Vrondas from OzForex in Sydney and Chris Gore from Go Markets in Melbourne. Welcome. Good morning to you both. Chris, let's start with you. How much of the US dollar weakness that we saw on Friday have to relate to that budget showdown?
Yeah, certainly it would have had an effect. I don't think it put a significant dent in the US dollar, and certainly not for the longer term. The effects are generally what we see is quite nominal. In the event of a shutdown, it's generally perceived as a short-term thing and not necessarily a whole lot of weakness to be seen. But we did see the US dollar weaken on Friday for other reasons, of course, in conjunction with this government shutdown. Of course, at the moment, what I'm eyeing as one of the prime indicators at the moment is the price of crude oil. A continuance of this positive crude price action, of course, derived from the events of Middle East and Northern Africa, continue to have a strong effect and push the steam behind crude oil. Importantly, the crude oil and US dollar relationship is that of an inverse relationship. The same goes for gold and silver. And all of these factors are certainly having the effect where the US dollar remains in the doldrums. So essentially, this has been a common theme for some time.
Jim, what do you see as the biggest pressure on the US dollar? And was any of the sort of impact from that budget showdown mostly psychological?
Well, I think the important thing to come out of Friday as well is the possibility and the likelihood that the US will have to raise their debt ceiling from 14.3 trillion US in order to meet its obligations, I guess. So that's quite critical. I think that did put a dampener on the mood towards the US dollar and probably will continue to do so for the majority of this week. How much they'll have to raise that cap to remains a question. How much more do they need? It is a bit more of a short-term solution, I guess, in terms of raising the cap. It buys them some time to be able to deliver some of these spending cuts and have them feed through the real economy. So there is some negativity from that. We've got deficit kind of likely to reach 100% of GDP this year. So that is quite massive. So I think there is a concern there from the market in relation to the size of the US deficit as well.
You think massive doesn't even necessarily describe the US deficit. But do you think in any way that we could see a relief rally for the US dollar now? Because at least they shook on a deal, even though there's still so much to be determined.
Possibly, although it's still a bit early to tell. There have been several signs along the way that we could have seen a US relief rally by now, and we haven't. So this could be another false dawn for those trying to pick a bottom in the US dollar, which is quite a risky strategy. Most likely, I guess the best way to keep playing these markets is sticking with the trend at this point in time rather than trying to pick an end to the trend.
Now, Chris, I guess enforcing the market view that there's no real credible plan in place for the US to improve its fiscal position is the fact that the Canadian dollar rose against the US dollar despite an employment report that missed expectations. I mean, is that how you say it?
Yeah, certainly. One of the great advantages the Canadian dollar has at the moment is certainly that of the price of crude oil. As I mentioned, I've particular belief at the moment is as a primary factor which is governing and a key directive for most currencies, and certainly that of the Australian dollar and the Canadian dollar as well. So that's a primary theme in looking forward in terms of what's going to happen with CAD. And at the moment, we have interest rates coming up this week for Canada, and although it does appear as though the interest rates will remain on hold, there is a case building where we should very well see at some point in the next quarter an increase of interest rates in the Canadian dollar. We believe that would place some steam behind the CAD in the near term. Markets are very much forward-looking, so we will be concentrating more on the inflationary picture of Canada in the days to come.
And Jim, what is the sort of snapshot of the Canadian picture overall? At the Bank of Canada meeting this week, and interest rates there are still quite low, right?
They are quite low, and interesting this move with the CAD has been it's traded at its highest level against the greenback since 2007. So it is trading at historical highs against the US dollar. The Bank of Canada has been quite vocal in mentioning the negative effect of that strong Canadian dollar, and I think that's actually one of the things probably holding them back from having raised rates already at this point in time. With inflation quite high, I think the Bank of Canada is ready to pull the trigger, but I think this level of the Canadian dollar is a concern to them at the moment.
Yeah, how long can they hold off? Because, I mean, we are in the sort of global environment, Chris, where we're seeing these central banks start to move on rates. We're seeing, the European Central Bank raising rates and possible talk of a further rate rise. But then, of course, there's the contrast where the Bank of England, the doves are still winning there, even though inflation is more than double the central bank's target. So how long realistically can the Bank of Canada, can the Bank of England remain on hold?
That's a very good question, and I'm not entirely sure. Looking at the Bank of England, there's an entirely different thing at play here. We obviously have growth at less than desired levels amid high unemployment, and of course inflation at twice that of its underlying target. So that's at 4.4%. Against an inflation target of 2%, so that's certainly astronomical in the sense that they really need to do something and do something fast. But I think the key here for the Bank of England is going to be the descent, or division is generally the first sign of change. As we know, we now have three dissenters from the Bank of England. If we look at Martin Wheel, of course, the long-term dissenter Andrew Sentence, and another colleague as well who have come out and voted for an increase. However, then we have Adam Posen. So it's playing out more like a soap opera at the moment. We've got Adam Posen actually requesting more quantitative easing. But we're of the opinion with the sterling in general that it does have some ways to go. There's certainly going to be some catch-up, and we do believe that next meeting that we will see an increase in interest rates from the Bank of England. And certainly this week from a UK perspective, we have CPI, which is expected to show underlying inflation or actual inflation at 4.4%. So there's no signs of moderation. The week after, of course, we have the minutes of the Bank of England meeting, and we could very well see some more dissent from these members here. Very important thing, and certainly very important thing for sterling in the coming weeks.
So, Jim, do you think that it could be potentially a volatile week for the pound, given the backdrop and some of the economic data that is to be released? I believe that we're expecting unemployment data on Wednesday.
We are, and we're expecting the claimant count to improve in the UK as well, looking at about 10,000, or a drop from about 30,000 in terms of job seekers out there. So there is likely to be some improvement in the UK employment outlook. That inflation number, as Chris mentioned, expected to remain stubbornly high at around 4.4%. And we also saw a producer price data out on Friday, both inputs and outputs in the UK rising. So inflationary pressures are likely to continue to persist and I guess force the hand of the Bank of England at some point soon. Whether it's next meeting, as Chris suggested, or the meeting after, does seem likely that we probably will happen somewhere around by the middle of this year.
Okay, we're running out of time again. So, Jim, quickly, where do you see the support level for the Australian dollar back here at home?
Definitely, obviously, around that parity level is going to be quite well protected. Before then, they were looking at around 104.5 as a level. We saw it push close to 106 on Friday. So, in the short term, for the majority of this week, we think the Aussie dollar will remain well supported on the dips. Chris,
is the upward momentum continuing for the Australian dollar? Where do you see it heading?
We believe the global macro environment is certainly conducive for Aussie dollar gains going forward. One of the themes, of course, we're watching out for is corporate earnings this week in the States. And once again, the price of oil. It's been one of the correlations that I've been spotting quite a lot, where we do see the US dollar moving in accordance to what happens in crude oil. And what's of particular interest to me is that certainly the Aussie dollar from a technical perspective is due for a reprieve. I'm of the same opinion as Jim, though. We are going to be supported in the dips until such time as what we see is a sustained rally from the US dollar. I believe that there's a lot of focus being put from a local perspective, and of course China, which is very important, but certainly what we really need to be concentrating at the moment is what's happening in the States. We're seeing this signs of division from Fed members, and this, in my opinion, will govern the long-term direction and of the Australian dollar.
Just quickly, Chris, I mean, we were talking about 105 for the Australian dollar last week. Now people are talking 110 for the Australian dollar. When do you see that realistically happening?
Well, I believe the window of opportunity was within the next 2 months. And for the reasons I just suggested in terms of US dollar strength, we do believe that the US dollar is due for is well overdue for a reprieve, and of course we're seeing that signs of division. However, this has eluded us in the past, and of course we do need to give it a decent amount of tolerance there. But I believe that we do have the next 2 months for the Aussie dollar to achieve its optimum level, and that could very well be in excess of 108 US cents, and certainly judging by its rate of ascent, it's not impossible by no means.
All right, we appreciate your time. Chris Gore from Go Markets in Melbourne, also Jim Vrondis from OzForex joining us from Sydney. Thanks so much. Have a great day.